Are balloon payments allowed on HELOCs? Have you ever wondered about the specifics of home equity lines of credit and whether balloon payments are part of the deal? Let's break it down. Home equity lines of credit, often referred to as HELOCs, can indeed include balloon payments, but there are important regulations and lender policies that come into play. So, what exactly is a balloon payment? It is a large lump sum payment that is due at the end of the loan term. This usually happens because the monthly payments during the draw or repayment period do not fully cover the principal balance. From the perspective of banks and credit unions, balloon payments on HELOCs are allowed, but lenders must clearly disclose this information to borrowers. If a HELOC includes the possibility of a balloon payment, the lender is required to inform the borrower that the minimum payments may not fully repay the outstanding principal. This means that a large final payment could be required. Even if the balloon payment is uncertain or unlikely, this disclosure is mandatory. If the structure of the HELOC guarantees a balloon payment, such as when payments are interest, only during the draw period, the lender must explicitly state that the entire outstanding balance will be due in a single payment at the end of the term. Interestingly, the term balloon payment does not have to be used in the disclosure, nor does the lender have to specify the exact amount of the balloon payment in the initial disclosures. Balloon payments are more common in HELOCs that have a repayment period shorter than the amortization period. This means that monthly payments cover interest and only part of the principal. For example, if a borrower has a $50,000 HELOC amortized over 20 years but with a 10-year term, they might face a balloon payment of tens of thousands of dollars at the end of those 10 years. From the lender's standpoint, offering HELOCs with balloon payments can provide borrowers with lower initial monthly payments and increased access to cash. However, lenders must also manage the risks associated with the potential inability of borrowers to make those large final payments. This includes working proactively with borrowers as the balloon payment approaches, offering options like refinancing or extending the repayment term to avoid default. Regulatory considerations also play a role in how balloon payments are handled. Loans with balloon payments are generally not considered qualified mortgages, which meet specific consumer protection standards, except in limited cases. Therefore, lenders must be careful in structuring and disclosing these loans to comply with consumer protection laws. In summary, balloon payments are indeed permitted on home equity lines of credit, but they come with strict disclosure requirements. Banks and credit unions must ensure that borrowers understand the potential for a large lump sum payment and be ready to assist borrowers in managing or refinancing such payments. This helps maintain good relationships with borrowers and mitigates credit risk.